So we are taking a look at Tesla stock today, breaking down what is currently taking place. And trust me, you're going to want to watch this video in its entirety, especially because we are approaching a critical area for Tesla. And we're going to go ahead and talk about Tesla stock both from a technical perspective, but as well as touch on some of the macroeconomic data that we're seeing rolling out. But with that said, I want us to take a look at Tesla stock's price action for today, as we saw a lot of selling pressure towards the beginning of today's trading session. However, as we pretty much ended off into the end of today's trading session, we saw a lot of buying pressure take place, but overall we saw Tesla close lower than the day prior. Now we're going to go ahead and talk about why we're in a critical area, but I want to highlight some data that I think is important to watch out for. Now, if you're subscribed to the channel, I have been pretty much warning about some selling pressure for Tesla going on for a while now, and believe me, I don't make these videos because I just want to put a lot of fear into people. I make these videos because I want to inform everyone of what is currently taking place. Now, something notable that we're seeing is that the 10-year treasury is at these high levels that we have not seen in a very long time, and this is putting a lot of pressures on equities. And I've been pretty much sounding like a broken record explaining that this is not good, and I've been telling both individuals in the Push and Profit private group but also publicly on this YouTube channel that this isn't good for the stock market. And the reason being is that simply when you have the 10-year treasury at these high levels, it's very attractive and it's a drain of liquidity for the stock market. Because think about this, why would an investor want to hold capital in stocks right now, which is very risky? We're in a volatile season when the 10-year treasury seems very attractive. You could put your capital to work in the 10-year treasury and get this guaranteed return of 4.6%. And so one of the things we have to understand is that a lot of these institutional investors, which we have to remember, institutional investors make up 70% of the trading activity in the markets. And this is according to the data by FINRA. This is not me just saying things randomly. This is what FINRA is saying. So a lot of these institutional investors that shape the direction of the markets, they have reaped in so many benefits in the first half of 2023, where we've seen the big seven like Tesla, Apple, Nvidia, Meta, Microsoft, all these big stocks, all these tech giants have been doing very well in the first half of the year. In fact, that's something I told the Push and Profit private group, that the first half of the year is going to be seen as a great recovery after what we saw in 2022. But the second half of the year is very questionable and things are looking very shaky. And so what we're seeing is, especially if you go on X.com, formerly known as Twitter, a lot of these institutional investors and fund managers, you see them pretty much salivating at these high yields. A lot of them are saying, hey, I think I'm going to take my money out of the market and park it in the 10-year treasury right now just to hold off, as we are in a very volatile moment. Now, I'm not saying that if you're a retail investor, you should do that. Of course not, right? Because one of the benefits that a lot of these these exchange-traded fund managers have is that they have some tax incentives and advantages that retail traders don't have. And I'm not going to go into the details on that. You could definitely just look that up. But for us, it's not easy to just roll out capital, and I've been investing in Tesla since 2017, and I don't intend on selling Tesla at all in my long-term portfolio and moving anything to the 10-year treasury. In fact, the way I approach the market is that I have my long-term portfolio for Tesla, and I keep adding in, but I do hedge it with my short-term trading account, and I trade the short-term fluctuations in price. So if Tesla's going down, well, I short it in my short-term trading account to hedge my long-term portfolio. And this isn't something foreign, right? Hedging your portfolio is not foreign at all. In fact, there's many ways to do it. We see investors like Warren Buffett, where the way they approach this is that they invest into stocks long-term. Of course, we know Warren Buffett's a long-term investor. And when stocks are going down, what will investors like Warren Buffett do? Well, they'll sell calls on their stocks. This way, as the stock falls down, they are still collecting on the premiums to hedge on their positions. And you also have other investors who buy puts, and they use that as an insurance. So when the markets are going down, well, they're still collecting or hedging against their position by making up with the shorts on their puts for their stocks. And so there's multiple ways to play the market. Some managers like to rotate capital. Some like to buy insurance with puts. Some like to, like myself, have a separate trading account where this is not for institutional investors. This is for myself as a retail investor. I like to invest long term and hedge with a short term trading account. I mean, there's several ways to approach it, but nonetheless, when the 10-year treasury is this high, it's very attractive to move capital around, and that drains the overall markets. This is why when we take a look at Tesla for today, we saw with the 10-year treasury making a new high, this wasn't good for the markets. In fact, let's take a look at the S&P 500 index ETF SPY. We see the same exact type of price action. Now, I want us to pay attention to the U.S. Consumer Confidence Index as it is currently dropping, and we're going to go ahead and look into that data, but I really quickly just wanted to show you guys and have a little laugh over here where they have this image of this man in this article looking at meat and the price of the meat, and the reason I find this hilarious is because this is the exact face that I have when I go to the supermarket and I see just prices of meat just at these absurd levels. I mean, it's almost making me want to be a vegan at this point, but being vegan isn't cheap either, right? Unless I'm eating grass. But this is exactly the same face I have. Now, let's go ahead and take a look at the U.S. Consumer Confidence Index. Now, we're seeing this trickle downwards, and of course, this is not like a real good indicator, but generally speaking, when people are feeling bad about the economy, that's not a good indication of how things are going. But more importantly, I want us to take a look at the present situation and expectation index of consumer confidence. Now, this is different because the U.S. Consumer Confidence Index is just a general outlook on both of these numbers. But when you look at the present situation index for the consumer confidence as well as the expectation index, well, we see a big picture over here. So the expectation index, which is what consumers are expecting, is below 80 now. And historically speaking, every time we are below 80, well, that has been presented as an area where a recession is most likely taking place. Now, of course, there are a few exceptions, but this is what we're currently seeing. And then obviously the present situation is trickling down, but it's not as bad. Now, I want us to actually take a look at something else, as the Consumer Confidence Index is a reminder of something I talked about a couple of weeks ago, and that is the leading economic index, right? Now, the leading economic index is an index that compiles many different indexes that is a general indicator, right? It's forward-looking of what the economy is currently doing, and it's been declining consecutively for months. Months after months, it has been going down, and this is not a good sign for the economy. Now, if you want to see how the leading economic index is measured, you could look at this chart over here where the higher it is, the more weighting that it has on the overall markets, and the lower it is, the less weighting. And one of the things you'll see is that pretty much everything is going back or contracting. I mean, the interest rate spread is not good. The leading credit index, which is just basically showing us how difficult it is to obtain credit, well, that's contracting. All of this is not good news. ISM new orders declining. I mean, we want to see the GDP and the economy grow, and the only way you could see that is by, of course, seeing more production in the economy. And ISM new orders is not telling us that, right? And so what I'm trying to point out here is that the leading economic index, as well as what we are seeing currently with the consumer or the U.S. Consumer Confidence Index, is not painting a good picture. Now, I want us to take a look at what we're seeing over here on this chart, which is pretty much the future markets pricing in their price targets for the possibility of what the Federal Reserve is going to do on its next meeting for November 23rd. Now, we've seen for a while and talked about how a lot of market participants are calling the bluff that the Feds are actually going to hike an additional 25 basis points to this 550, 575 range, and that 75% or more of the market is pretty much expecting that the Feds are going to pause. But interesting enough, this number recently climbed up. Now, I want us to take a look over here. So I want us to kind of just scroll down over here. Now, a month ago, this number was 46%. 46% of market participants priced in that the Feds were going to hike. A week ago, it dropped down to 28.9%. So again, the market was calling the bluff for the Feds. And then just yesterday, this was at 16.4%. Again, a lot of confidence and conviction that the market or the monetary policy of what the Federal Reserves are going to do as far as making an update to monetary policy was that they were not going to hike. But now we're seeing this number actually increase to 25%. So now the future markets are pricing in a 25% chance that the Fed is going to hike in November. Now, why is it that this number is climbing upwards? Well, here's the thing. We know that right now, so far, the data that we have been getting and receiving has been pointing out to the fact that it's very unlikely that the feds are going to hike. But the looming concern is a government shutdown. Now, it's not that a government shutdown is going to be bad for the economy. That's not what it is at all, right? It's not that that's going to change any of the fundamentals for the economy, but the fear with a government shutdown, because our politicians can't get things together and are going to have to force itself to shut down, is that we're going to have key economic data not rolling out. For example, when there's a government shutdown, not all functions of the government is working. Of course, people who are receiving their social security checks, that still rolls out, and there's still some components of the government that's still working. But think about the Bureau of Labor Statistics. They are not going to be able to roll out data if a government shutdown takes place. And so what we've seen is that Fed officials, we saw Kashari in yesterday's video, I talked about one of the Fed or FOMC members saying that if the Fed does not get the data because of a government shutdown, meaning that they can't even get government data to navigate them, that they are just going to have to navigate in the dark and do the best that they can as far as shaping monetary policy. Now, this is causing a little bit of fear into the markets. Why? Well, that's the Fed basically saying, hey, if the government shuts down, we're going to have to do some guesswork, and yeah, we're going to have to do our best to guess what we should do. Maybe we should hike, maybe we should pause. Now, this isn't really good news because we know that even when the government or the Federal Reserve has gotten data and it wasn't rolling in the dark, they've made bad decisions. Now, think back to 2021, where the Fed said that inflation was transitory, and fast forward now, well, that was completely wrong, and inflation is still a battle for the Federal Reserve. And so that was them receiving data and still getting it wrong. Imagine how wrong the Federal Reserve could be when they're navigating in the dark without getting data. And the analogy I try to think of this is, imagine rolling or walking through a graveyard, and you have a candle to light the way, but that candle is slowly burning out, where now you're going to have to make it to the other end of the graveyard at a pitch dark lighting without any candle or any light to guide you, and the light obviously being economic data. That's not a good look. And so that's why the markets are kind of panicking a bit and pricing in that, hey, maybe it's a little bit more likely that the Fed may actually hike. Now, I want us to pay attention to this calendar of economic data that we are getting, because fortunately, we are still getting some data before this expected government shutdown. Now, Goldman Sachs is saying that it's likely that there's a 90% chance that the government would shut down. Well, I want you guys to comment in the comment section below. Do you guys think the government will shut down, or will they actually get their stuff together, right? We know Goldman Sachs is saying it's very likely that they will shut down, but I want you guys to comment your thoughts in the comment section below. But at least the government shutdown wouldn't be till October 1st. And so that means all the data coming out after October 1st could be completely gone and not being able to come out, like the job openings report, as well as ISM services, initial jobless claims, the employment data such as U.S. Employment reports, like which is the unemployment rate, U.S. hourly rates, all the stuff that comes out with the typical job data. Luckily, the ADP employment report is a private number. It's not a government number. And so we still are going to get this data. And so that's fortunate, right? That comes out on October 4th. So even if the government shuts down, we still get some data afterwards. But again, all this data is going to be missing. Fortunately, before then, we still have the data coming out tomorrow and Friday. For example, tomorrow we will get our initial jobless claims, which is basically a weekly report we get. And this is different from unemployment. This is just people filing for unemployment. So we're going to get an update on that job data. Of course, tomorrow at 4 p.m., we're going to have Fed Chairman Jerome Powell speak, and that's going to be something we want to pay attention to, because we want to know, is the rhetoric from Jerome Powell going to change? Is it still going to be hawkish, or is it actually going to be a bit dovish? Then after that meeting, now I'm sure that the whole script that he's going to say is that the Fed is going to have to be data dependent. And of course, that's not a bad script. I think it's important to say data dependent, but that's most likely what he's going to say. I believe he's going to stand his ground and still be hawkish. But of course, we have to wait and see what he says for his meeting or his speech tomorrow. But after that, Friday is the real big day. Why? Well, we're going to get the PCE data, which is the Personal Consumption Expenditure Report. And this, just like the CPI, is an inflationary gauge on how inflation is doing for the overall economy. Now, of course, we know that headline inflation has a possibility of still tricking upwards. This is what we saw with the CPI report, the headline CPI. Why? We're seeing energy trickle upwards. Why? Well, we see what Russia and Saudi Arabia is doing to stifle oil production, which is causing energy like oil to go up, which is why we're seeing high prices at these gas stations. But we have to understand that headline inflation, right, is very volatile, and it could get manipulated by people or by bad actors, right? And so that's why you always want to really pay attention to the core CPI or the core PCI, PCE index, because this excludes those volatile numbers like food and energy, and it just tells us how inflation is doing at those core levels. And we want to see what happens here, because this is going to be the big shaper of the direction for the overall economy going into next week. Why? Well, we know that if inflation trickles upwards, that it's very much likely that the Federal Reserve is going to have to hike. Now, if we see these numbers actually cool off a bit, well, then most likely we're going to see the future markets once again price in a lower prediction that the Feds are going to hike. So this is a huge report that we want to pay attention to for Friday. Now, lastly, before we go ahead and take a look at the price action for Tesla, I want to highlight some alternative data over here, as I always find alternative data very interesting. Now, we've seen that a lot of the CNBC recommendations have recently been bearish for Tesla, just as I've been bearish for Tesla in the short term. But we saw that Jim Cramer was actually bullish for Tesla on September 6th. Now, I'm not saying that Cramer is always wrong, but there is a reason why there is a reverse or inverse Cramer index, where every time Cramer or Jim Cramer says something on CNBC, you want to do the exact opposite. In fact, many who have done the opposite of what Jim Cramer has been calling out has been very profitable. If you take a look at the Jim Cramer index, you'll see that if you just short or do the opposite of what he says, you'll be a very rich man. Now, let's go ahead and take a look at Tesla, both from September 6th, and then take a look at where we're currently at. So let's go ahead and switch over to a daily time frame, and let's take a look at September 6th. Now, September 6th was right over, and this is actually the SPY. This is why it looks off. Right over here. September 6th was right around over here. Now, we are clearly much lower than we were in September 6th. But some of you guys may say, well, Jim Cramer wasn't entirely wrong because Tesla did pop up. Now, here's the thing. Tesla only popped up around this area simply because we had that catalyst event of one of the analysts from Wall Street's now saying that, hey, we shouldn't just look at Tesla as a automobile company when it comes to Wall Street looking at Tesla, and we should also take a look at Tesla more as a tech company, kind of like how Amazon just isn't a delivery company, but they have their Amazon Web Services, which makes up a huge portion of their profits. And so when that analyst came out with that report, we saw pretty much everyone very much hype up Tesla, but fundamentally nothing changed. From Tesla here and here, nothing changed. It was just a good report. And soon after, that pretty much died off, as again, it's not a change to the fundamentals. This is just hype, and hype doesn't last very long. Now, when we're taking a look at Tesla from a daily time frame, let's take a look at a couple of things, right? So first off, we again declined off this descending trend line, which I have called out for a while now as an area where every time Tesla goes up here, we want to pay attention if we break above it, because that would signal that we are making a new trend upwards, or if we get rejected. Clearly, the case was that we got rejected. After we got rejected for Tesla, I said we're going to see some selling pressure, but we want to pay attention to what Tesla does around over here, because we know that here there's a lot of volume relative to price, and when there's a lot of volume relative to price, that means that there's a lot of exchanging between buying and selling, and when there's a lot of exchanging between buying and selling, that causes areas of consolidation or supports and resistances. This is why when we were around this area previously, Tesla went up, it went down, it went up, it went down, it went up, it went down. It was pretty much consolidating because, again, this is where there's a lot of volume, a lot of exchanging between buyers and sellers. Everyone's pretty much debating about the price. Of course, we had the catalyst event that took us out of here. We got rejected. We came down, and guess what? We actually broke below it. And now we're at this area where there's this volume pocket. Now, when there's this volume pocket, that means that there's little volume relative to price. And then so we see selling pressure around this area. That could pretty much have Tesla stock capitulate downwards, because if there's selling pressure and there's little exchange between buyers and sellers, that would mean that the sellers are taking over, and that would push the order books downwards, right? Just as if inversely there were buyers around this area, we see that pushed the order books upwards. So what we're currently seeing is, well, Tesla broke below it, and as it broke below it, we saw that the buyer stepped in. That's why we saw this wick over here on this green candle, and we saw that the buyers had demanded for Tesla prices over here, that some demand entered into the market, and Tesla went up. But I said, hey, this is now an area of resistance, and so that's why Tesla wicked downwards. So we had a wick going upwards and then a wick going downwards. Then we had today where Tesla actually closed down, but then at around right over here for $233 or $34.75, the buyers once again stepped in. So it looks like buyers are coming in, but if we have some more weakness in the overall economy, especially with the PCE numbers coming in on Friday, and then of course a week later we're gonna get an update on the fundamentals for Tesla, as we're gonna have the delivery numbers, and we know that it's most likely not gonna look good. But if it actually comes out worse than what we expect, well, we could see Tesla pretty much fall down even further. Now, if you're investing in Tesla in the long term, by all means, I am not telling you to sell or exit out of Tesla. You should always just do whatever you see value in, and anything I say on this video is not a buy or sell recommendation, right? In fact, I do not plan on selling Tesla in my long-term portfolio. All I simply do is when Tesla's going down, well, I don't just buy any dip. I wait for the selling pressure to take place. It continues to happen, and once we see confirmation of an uptrend, something that I talk about within the Push and Profit private group, that's when I go ahead and buy into. And that's when I actually bought into Tesla in my long-term portfolio around over here. I average in. Tesla started going up, and now it looks like things are going down. Well, if Tesla continues to fall down and possibly even reach this gap over here that we're seeing at around 170, well, guess what? Once I see a confirmation that the uptrend is coming back again, I'll go ahead and average into my long-term portfolio. It's a very simple method for long-term investing. I know some individuals do dollar cost averaging, where every single month they add an equal amount, and that's definitely something you could do as well. I tend to only do that for my index ETFs that I invest in, but when it comes to individual stocks like Tesla that I have in my long-term portfolio, I prefer to not do that and really just wait for that selling to take off and wait for that confirmation to present itself. Again, that's just my personal perspective and approach for Tesla, and you are free to do, again, whatever you see value in. You should not copy what I say or anyone else on YouTube or any of these fund managers, especially, right? Because we have to understand that these fund managers play by a different game. In fact, in a recent video, I talked about how Kathy Wood of ARK Invest, although she's very bullish on Tesla, she's recently has sold about $46 million worth of Tesla in the last within the last 2 weeks, and it's not because she's getting bearish on Tesla. I mean, that may be part of the reason in the short term, but again, these fund managers can't expose themselves too much in one particular stock. In fact, there's actually laws like the Investment Act of 1940, Section 501, I believe it's B, if I'm not, you guys could fact check me on that. But the case is that these fund managers play by a different game and have to adhere to different rules, whereas a retail investor, you don't have to worry about how much allocation you have to one stock. I mean, you could have 100% of your portfolio on Tesla if you wanted to. There's no one to tell you can't do that. You could have 100% of it in a garbage penny stock. There's no rule against that. But again, these fund managers have specific stipulations that stifle them from being able to have too much weighting in one stock. And so that's why you can't just copy them either. You shouldn't copy anyone. You should only do whatever you see value in. Now, if Tesla continues to fall down, we do have a weak PCE number, or I guess a hot PCE number, right? Or core PCE coming out hot. Well, I will most likely continue to short Tesla to hedge my long-term position. And if we get the delivery numbers next week and they come out worse than expected because of the sales in China, which I talked about in yesterday's video as well, well, again, that's probably going to fuel the flame for Tesla stock to capitulate. But with that said, I'm going to end this video right over here. Let me know what your thoughts are on Tesla. And before you go, make sure to subscribe and watch this next video right over here, where I talk about how to identify confirmation in the market. Definitely check out that video, and I'll see you guys on that next video. Take care.